the Fed in its FOMC minutes pointed out that there's a disparity a little bit. The financial markets seem to be a little bit uncertain from time to time, but the core economy seems to be doing quite nicely. Now, how do you just explain why the financial markets seem to be nervous and the core economy seems to be growing at a pretty good rate?
So financial markets really beginning in the fourth quarter got more volatile and seemed to be pricing in a more pessimistic outlook, which, as I mentioned, seems to be rooted in concerns about slowing growth and a related concern of the ongoing trade negotiations. So, if you look at the incoming data right through the end of the year and into the beginning of this year, you don't really see any evidence of a slowdown. And so we're in a situation where we have factors pointing in different directions. And by the way, this is not uncommon. This is actually something that happens not infrequently. And when we have that, what we do is we apply sort of risk management principles. In other words, we're not just concerned about the baseline case. We're thinking about what are the risks, and we're using our tools to address those risks. So in that case, what does it mean? It means first, there is no preset path for rates. There really isn't. There never is, but there particularly isn't now. Second, as I mentioned, it gives us the opportunity to be patient and watch and see what does evolve. Are we going to see the more positive view that most forecasters have of this year, or are we going to see slowing global growth, and are we going to see that affect U.S. growth? If it does, then I can assure you, it's a common thing for the economy to behave in ways that are not exactly as we expect, and when that happens, we can flexibly and quickly move policy. We can do so significantly as well if that's appropriate. So we'll always use our tools to try to sustain this expansion and keep the labor market strong and inflation low.
So currently, the Fed is projecting the U.S. economy is going to grow in 2019 at 2.3%. I believe that's your number. It previously was a little bit higher, 2.5%, I think, last year. You've lowered it. Is that correct? And are you going to lower it again because of the government shutdown? Is that going to affect the economy, in your view?
Let me say first, there is no official Fed projection. What 2.3% was the median of 17 participants. So they were half above and half below that. We'll during the year, not infrequently, in fact, typically when we submit new projections every quarter, the projections will change. I mean, it's very difficult to forecast the economy to that level of precision. And, so we'll take into account tightening financial conditions, which we've seen, and we'll also, lower our rate path and try to have monetary policy offset weakness before it even happens.
The shutdown, what's the impact on the economy in your view?
In the short term, if government shutdowns don't last very long, they have typically not left much of a mark on the economy, which isn't to say that there's plenty of personal hardship that people undergo, but at the aggregate level, the economy generally does not reflect much damage from a shutdown. A longer shutdown is something we haven't had. If we have an extended shutdown, then I do think that would show up in the data pretty clearly. And I would say, particularly from our standpoint, one of the agencies that shut down is Commerce, which has the Bureau of Economic Analysis and the Census Bureau, and some of the pretty important data that we get is published by them and would not be published, including retail sales and GDP and a bunch of other things that are coming out this month. So we would have a less clear picture into the economy if it were to go on much longer.
You don't gather your own information. You rely on other agencies to give you information?
In most cases, we're getting information from the Bureau of Labor Standards and BEA. We do have a handful of data series that we collect ourselves.
Okay, and so today, let's talk about the economy going forward. We're close to the longest period of expansion since World War II, and we could break that record. Do you see anything on the horizon that would make it likely that we would go into a recession in 2019?
I don't see anything that suggests that the possibility of a recession in the near term is at all elevated. Recessions are most often caused by two things. One is inflation that is high enough that the Fed has to hit the brakes. We don't see that. More common recently in the last several cycles, it's really been a matter of mounting financial imbalances, by which I mean asset bubbles, the housing bubble, the dot-com bubble, or just excessive leverage, as you saw in the subprime mortgage area, where those things happen. We don't see that either. So we don't see the two most basic recent causes of recessions. We don't see those risks. So I would say the possibility is not elevated at the moment.
So you don't see any worry, you're not worried in 2019 about anything close to a recession?
I don't see a recession. I would say that if you ask me what am I worried about, I would say the U.S. economy is solid. As I mentioned, there's good momentum going into this year. The principal worry I would have is really global growth. If you look at Asia, look at Europe, you're seeing slowing in growth, and the question will be, how much does that affect us? It's a tightly integrated global economy and global financial markets, and we will feel that.